Okay, let's dive into this explainer and uncover something that feels like an absolute cheat code but is entirely legal. We're going to look at exactly how FIRE couples avoid taxes. People pursuing financial independence and early retirement can take complete control of their money to pay absolutely nothing in federal taxes. Yes, you heard that right, $0. Here is our roadmap for today. We'll cover the zero tax superpower, expose the magic math, break down the three-bucket framework, dive into tax gain harvesting, go over the crucial rules and guardrails, and finally, wrap it up with the ultimate combo move. Let's get to it. Section 1, the zero tax superpower. And spoiler alert, no billionaires are required for this. So how exactly do FIRE couples legally pay $0 in taxes? Well, let's shatter the myth right now that dodging the tax man is only for billionaires with fancy offshore accounts. When you work a standard W-2 job, you know the drill. You're basically just along for the ride. Your employer reports your income, they withhold the taxes, and you just get whatever's left over. But early retirees, they legally pay $0 because they put themselves right in the driver's seat. They completely control three crucial things: the type of their income, the timing, and the amount. And because the IRS doesn't treat all income the same, having that control, it's literally everything. To put this into perspective, what's absolutely staggering is that in the year 2026, a married couple can realize up to exactly $131,100 in capital gains without paying a single dollar in federal income taxes. We're not talking about a reduced bill or a deferred bill. We're talking about exactly $0. This setup brilliantly illustrates the superpower. We're really looking at two totally different worlds here. On one side, you have ordinary income. Think your W-2 job or withdrawals from a traditional 401k. This gives you practically zero control and hits you with high ordinary tax rates. But on the flip side, you have long-term capital gains from a standard taxable brokerage account. This gives you total control, and depending on your income, it unlocks a massive 0% tax bracket that just sits there at the bottom of the IRS tax tables waiting for you to use it. Moving right along to Section 2, the magic math exposed. And yes, this is printed right there in the IRS tax code. I want to prove to you that this isn't some shady underground hack. It is baked right into the rules. The 2026 IRS tax brackets for long-term capital gains are fascinating. If you check out the lowest threshold, you'll see exactly where these gains are taxed at literally 0%. For a single filer, it's up to $49,450 of taxable income. And for a married couple filing jointly, that 0% bracket stretches all the way up to $98,900. Keep in mind, these aren't poverty-level numbers. These are comfortable middle-class salaries for millions of people, completely tax-free. So the crucial point is, how do we get to that massive six-figure number we talked about a minute ago? Well, the capital gains bracket applies to your taxable income. That means we get to subtract the standard deduction first. When you stack the 2026 standard deduction, which is $32,200 for a married couple, right on top of that $98,900 0% bracket ceiling, you engineer, that massive $131,100 tax-free ceiling. Let's see how this math plays out in the real world. Say an early retired couple needs to pull out $120,000 to live their absolute best life this year. They withdraw the $120K. But wait, the IRS only taxes the profit, not the total amount withdrawn. If they originally invested $40,000, which is known as their cost basis, their actual taxable capital gain is only $80,000. And because that $80,000 profit slides well under the combined threshold we just mapped out, this couple lives off $120,000 for the year and pays $0 in federal taxes. Which brings us to Section 3, the three-bucket framework. It's time to structure your wealth. Now, to actually make this magic math work, you have to build three distinct buckets during your working years. You need optionality. Bucket 1 is your tax-deferred money, like a traditional 401k. Great for saving, but withdrawals count as ordinary income, which can very quickly push you out of the 0% zone. Bucket 2 is tax-free, like a Roth IRA. Amazing for flexibility. But bucket 3, your standard taxable brokerage account, is the golden goose here. This is the only place where the 0% capital gains superpower actually applies. If all your money is trapped in bucket 1, you simply can't use this strategy. I absolutely love this quote from our sources. Taxes are a math problem, not a vibe. You cannot just manifest lower taxes, right? You have to engineer them. You do this by strategically pulling money from the right buckets at the exact right time, keeping your taxable income perfectly nestled within that 0% threshold. All right, Section 4, Tax Gain Harvesting. Let's look at a highly active tax strategy. Now that our buckets are set and the math makes sense, here is the blueprint for an absolutely incredible active strategy. Step 1, identify a low-income window. Maybe you take a sabbatical, you drop to part-time, or you hit early retirement, and your W-2 income drops to zero. Step 2, during this window, you sell your winning investments to intentionally lock in those gains entirely under the 0% limit. And step 3, this is the real kicker. You immediately buy those exact same investments right back. You see the wash sale rule that stops you from buying back right away? That only applies to losses, not gains. So you legally wipe out your future tax liability and permanently reset your cost basis higher.
Now, if you feel a little emotional about selling your winners because, hey, we've all been taught to never interrupt compounding, just remember this analogy. Tax gain harvesting is simply trading a $100 bill that has a $30 IRS IOU staples to it for a completely clean $100 bill. Your investment value stays exactly the same, but that embedded tax liability, it just quietly disappears.
Let's move into Section 5, Crucial Rules and Guardrails, because we definitely want to avoid expensive mistakes. As amazing as this whole system is, we do need to pump the brakes just a bit. There are real guardrails you absolutely must respect, because mistakes here are incredibly expensive. First off, this is a federal strategy. If you live in a high-tax state like California or New York, you might still owe state taxes unless you relocate. Second, realizing these gains does increase your on-paper household income, which could severely slash your Affordable Care Act health insurance subsidies. You've got to watch the ACA cliff. Third, you must do the math precisely. If you harvest even $1 over the threshold, that overage gets taxed at 15%. And finally, every single gain must be held for longer than 1 year. Otherwise, it's considered short-term and you'll get hit with much higher ordinary income rates. Finally, Section 6, the ultimate combo move. This is how you reduce lifetime tax drag. Let's tie the whole shebang together for those who really want to optimize their early retirement. In a low-income year, you actually have room in 2 separate parts of the tax code. You can execute what the sources call the combo move. You use a Roth conversion to intentionally fill up your lowest ordinary income brackets, shifting money from bucket 1 to bucket 2, and simultaneously you execute a tax gain harvest to fill up your 0% capital gains bracket in bucket 3. You are literally taking advantage of both systems at the exact same time. Let's look at the math on just how powerful this is. By combining these moves in a perfect low-income window, a married couple could, for example, convert $40,000 from a traditional IRA to a Roth. After the standard deduction, they only pay a 10% ordinary tax on the remaining $7,800. That's just $780. Then they go ahead and harvest $40,000 in capital gains. Since their total taxable income is now just $47,800, that entire gain sits comfortably inside the 0% threshold. The result? They repositioned and harvested $80,000 of wealth, and their total taxable was an astonishing $780. It is an astounding system. You now know this superpower exists, and you know the math behind it. But it leaves us with one critical question to wrap up this explainer. The IRS has literally handed you a legal cheat code to wipe out your tax bill. But are your 3 buckets actually structured to use it? If your portfolio isn't ready for your next low-income window, you aren't just leaving money on the table, you're basically tipping the IRS with your retirement funds. So the real question is your portfolio positioned to take advantage of your next low-income window? It might be time to start engineering your portfolio today, so you don't miss your window tomorrow.